Yeah.
All right, well, we'll get started. And then as other people jump on, we'll acknowledge them. And if not, we're giving really cool, intimate sessions to talk to two experts about financial planning, the markets, and real estate.
Mhm. Yay.
Yay.
I'm
Okay,
excited.
so I am thrilled to have, by the way, can you see this?
Yes, we can see it and we can hear you loud and clear.
Can you see the pictures of me and you on the
Yes.
screen? You can't see them now.
No, I can see it.
Okay, cool.
Yeah.
So I'm thrilled to have Courtney King hang out with us today. As you might or may not know, I've been doing a webinar once a month just to talk about a different financial topic. And so we've covered things like financial planning, DIY financial planning, how to start investing. And I think one of the misnomers about financial planners is that we only talk to you about investments. Some of us do, but I tend to like to look at my clients' entire portfolios and help to make recommendations where I can, and or make introductions to more qualified people in a specific space. And so one of the more qualified people is Courtney King with Redfin. Yay!
Thank you for having me.
Yeah, you're welcome. Thanks for joining me. Would you like to introduce yourself?
Yes, I'm Courtney King. I am the Texas state broker here at Redfin. I recently was promoted to broker manager, so I will be managing the state brokers across the nation at Redfin.
Oh my
And I'm really excited about that. Before joining Redfin, because I've been here for a little over a year and a half, I was a business owner. I am still a real estate investor, but I had my own real estate brokerage. And so I know, Kristen, a large part of your audience is entrepreneurs and entrepreneurs that, you know, their businesses are thriving and they want to know where's the best place to put their money. And so, so happy to be here. Kristen's the guru of all things financial planning, investments, insurance. I am a little bit limited in terms of I'm all real estate. I love investing in hard assets like real estate. And so I'm just happy to be here to lend a little bit of my knowledge.
Awesome. So the goal here, thank you. And congratulations. I got real excited. I don't know if you guys saw me.
Thank you.
Congratulations on
I
the
appreciate it.
promotion. My goal is really to help people build and become more comfortable with all different types of assets. So I know lots of people who are really comfortable with real estate or the ideal of real estate. So we want to empower them today to move forward if that makes sense in their financial plan. As always, if it makes sense in your financial plan, so run your own race, ask all the questions you want here today. And then if you have questions later, you're welcome to text me at the number below or email me info@herplanning.com or Kristen@herplanning.com, or go to my website and just schedule a call.
Awesome.
Cool. So here's an overview of what we're going to be talking about today. We'll first talk in high level about the state of the market and address questions like, is it even a good time to buy? And is there a real estate bubble? We'll talk about investment options. What are different ways you can invest in real estate? We'll discuss the differences between getting ready financially to buy an investment property and in a residential property. So you may own a home that you've gone through a process before on. This might be a little bit different. And then we'll also discuss some potential tax benefits to investing in real estate. So first, state of the real estate market. I'll pass it off to you, Courtney.
Thank you. So this is a big topic of concern for a lot of people. Right now, there's so much fear surrounding real estate. Are we in a bubble? Let me make it abundantly clear. I do not believe we are in a bubble. I do not believe this is 2008. Okay. I went through 2008. I wasn't in real estate at the time, but my dad was, and we were investing and flipping in Oregon at the time. And I think we learned a lot within the industry from that whole mortgage crisis and bust. And so I don't believe this is another 2008. However, I do understand that there's a lot of fear right now. And I think the big thing that that I hear day in and day out with customers and agents is, oh my gosh, these rates are going crazy. Okay. And I was on a call earlier this week, and one of the managers in Dallas, actually, and you guys, I'm just speaking from a Texas real estate perspective because that's really what I know. But one of the managers in Dallas sent me this really awesome graphic showing the rates over the last 20, 30 years. And I love seeing that because, guys, even though rates are in the 5s and sometimes 6s right now, that's where we were in 2017, 18, and part of 2019. Okay. So I always want to make sure that we look at the history, right? The market itself over the past 3 years has been insane. What do I mean by that? Low supply of properties, high demand, interest rates have been the lowest that they've ever been. And so it has driven a lot of traffic to people, individuals and investors that want to buy, want to add to their portfolio. And so where does that leave us now? Well, the Feds made some of the most significant rate increases over the past few months, actually just this year to date. And what that has done, and really the intention behind it is, okay, let's slow down the buying a little bit in hopes that the inventory will rise a little bit more and it'll offset some significant inflation that we've been experiencing. Okay. And so what we have been seeing all across Texas is fewer competitive offer situations. Okay. It means that some of the listings, if you ever go to Redfin, you will see price adjustments, right? New listings. That's one of the things that I love about our site. It really keeps the consumer up to date on what's happening in any given area that they're searching. And so what that means for buyers who are watching this broadcast is there's more opportunities, right? Now, ideally, hopefully you weren't a buyer that was negatively impacted by the rate increase, because the rate increase did knock some of those people that wanted to buy out of the opportunity to buy, because maybe their debt to income ratio isn't low enough to be able to qualify. A lot of those buyers that were at the cusp of, maybe between a 640 and a 700 credit score, that interest rate hike may have made it so that they're not able to buy right now. But if you are a buyer that, you have a 700 plus credit score, you meet certain minimum criteria, it's still a really good time to buy. And I think what we're seeing right now is less competition. We're seeing more deals. And I think if we're solely talking from an investment perspective, it's a great time to invest, because when we talk about interest rates, okay, we also have to talk about inflation. And the interest rates right now on a secondary property and investment property are still lower than the inflation rate. And so taking your money to buy a tangible, hard asset is still a really good strategy to consider when you're trying to figure out where to put your money. And then last but not least, since the rate hike, we have seen a little bit of an uptick in terms of the available properties and the available inventory to buy right now. So that's a positive thing. And I think we'll continue to see that. And at the same time, rents are crazy. I haven't rented in a very long time, but they're increasing so rapidly that if you're in a situation where maybe you're renting right now, we have some amazing lending partners with Bay Equity here at Redfin. They have a really good comparison that they put together for our clients to really show where are you really at, right? If you're trying to go into, leave renting and move into the buying space. So in a nutshell, I think we're in a really good place. And again, Texas, has weathered a lot of the storms that have had some significant impacts on the rest of the United States. So I don't know if all of our audience that are watching are from Texas, but we're in a really, really great place. And if you're not in Texas, but you're considering adding real estate investing to your overall strategy, Texas is an amazing place to invest, not only from a price perspective, a demand perspective, but also the laws favorably favor landlords. And that's something that you have to consider if you're going to get into the investing space.
That is something interesting to kind of think about. I tell people about Texas specifically because I'd say 60% or so of my clients are in Texas. There are factors in Texas that keep the market propped up. There's a bigger demand in Texas than there are in a lot of states, especially in North Texas, which is where I'm most familiar, just because there's so many companies moving there.
Absolutely.
It's really just like, yes, interest rates, yes, post-COVID, but also just simple supply and demand. They're not building fast enough to keep up with as many people that are moving there. So
absolutely,
that makes it a really great area to consider investing. So
absolutely. I personally live in Houston. I used to live in Dallas for about 11 years. We have offices in San Antonio, in Austin, and we are helping buyers. We're helping investors really capitalize on where we're at in the market right now. So it's a good place to be.
Yeah, I'm actually going to look later for that calculator because I love calculators.
Absolutely. And if you need me to grab one from our Bay Equity partners, just let me know.
Yeah, send it to me.
I sure will.
Maybe I'll send it out. Can you talk about investment options 1 and 2, and then I'll cover 3?
Absolutely. So a couple of options here are, you have your short-term, your vacation rentals. That's a big thing. We still help a lot of clients either start or add to their Airbnb portfolio. Now, it's not only Airbnb. There are a lot of short-term rental type options and services out there. But this is a good option. You obviously want to do your due diligence. So in any of these investment options, you really want to do your due diligence, because I have seen sometimes people, they may not check all of the VRBOs and Airbnbs, and then they end up buying in an area that's really, really saturated, which ends up forcing them to be uber competitive on their rental rate, but make sure you do your due diligence. Another option for all of my homeowners that are out there right now, a lot of people are basically transforming a space at their own home, whether that be a detached garage in the form of an accessory dwelling unit. Check your local laws. A lot of cities have different regulations with this, but that is another opportunity for you to convert part of a property that you already own into a short-term rental, especially if you just want to test the waters. Okay. Again, do your due diligence about that. But short-term and vacation rentals are excellent opportunities. There's a lot of turnover, so you want to factor that into your normal operating costs, because you have guests that are coming for days or weeks on end, which that's something that you can set. The other thing is, you want to make sure that you do your due diligence on the local regulations, because cities are oftentimes adding additional taxes to these particular units. Okay. So I think as a business owner, I mean, it's lovely because you can have this and you could potentially, again, not giving tax advice, but you could potentially take advantage of this when your short-term rentals are not rented and make it a vacation. And that would potentially be a business expense. And so there's some versatility there. Long-term rentals, this has typically been my strategy, where a tenant will be in place for a year or more. I like this because real estate is a multi-dimensional asset class. And so as you guys are crunching the numbers, there's so many different ways to figure out which option is going to be best for you. And a lot of people are only looking at cash on cash return. And I think if you only look at that, you're really limiting, number one, your opportunities, but your perspective is really limited. When I say a multi-dimensional asset, I mean, you're not only reaping tax benefits, right? Your mortgage interest is a deduction. You get to deduct all the property management fees and all of these things tied to your real estate investing business. And so we can't just look at the cash on cash return to determine if something is a good option. We've got to look at all of the different dimensions and the equity that you're building every month that your tenant is paying. Okay. I like long-term rentals. Again, low turnover. Generally, if you're a proactive landlord and you're kind of proactively maintaining the property, having the HVAC system service and all of these things, it really can just stretch and increase your overall return on investment. And I think if you intend to hold a property for a longer period of time, maybe 5 to 10 years, I like the long-term rental strategy. So I could literally go on and on about this. I love this, you guys. The book that I wrote, Millennial versus Machine, is how I got someone else to pay off my student loan debt using real estate investing. And that can apply for short-term or long-term rentals. It is, you're investing into an asset that's going to produce a ton of return over time. And so that's what I got in terms of short-term or long-term rentals.
I will send the link out to Millennial versus Machine
Awesome.
after our call,
Awesome.
maybe early next week. I did want to say too, I put a note in the chat. If y'all have questions or comments, I know one of you is really into this idea of short-term rentals. Please put them in the chat or unmute yourself or something so we can
Absolutely.
answer them. So some of you are, I know, specifically interested in investing in real estate and want to roll up your sleeves, find the property, work with a realtor to find the property, get a tenant in there, do repairs, all that stuff. Sometimes you're like me and you're like slightly less interested in that, but you still value real estate as an asset class. And so you do have the option to invest in mutual funds or ETFs that have some real estate exposure, or more specifically in REITs. So real estate investment trusts are like mutual funds, but with large pieces of real estate in them. So think about like who owns the shopping mall in the city where you live, the apartment buildings, the commercial buildings. Sometimes those are owned by large holding companies, and you as an investor can say, hey, I've got $250,000. I don't want to invest specifically in a house in my neighborhood or a condo in Dallas if you can find one for $250. Maybe not. Yeah. But I know I want to invest in real estate. And so you can invest in this fund and take part in the returns when they sell the property, or when they're generating rent from their tenants and get that in a form of a dividend. So there are other ways to use real estate to generate income, or just to be a part of the appreciation of real estate as an asset class.
And real quick on REITs, that is a really good option for those that are just like, I'm terrified about being a landlord and dealing with all of that. That might be a way just to kind of dip your toe in the waters to like start understanding how things go. I haven't personally invested in any REITs, but quite a few of my clients have. And there are different, services out there. And I know Kristen can keep us plugged in on different REITs that would yield the returns that we're looking for.
Yep. And you also can get them regionally. So like there's a guy in my email all the time who's like, I know you have clients in Texas. We have this really great Texas REIT. So if you wanted to have like specific to a region, you could do that. So if you have questions about that, let me know.
Excellent.
Let's talk about the financial requirements to buy our first or one of multiple investment properties.
Yeah, typically with investment properties, a buyer's required to put at least 20% down. Now, we'll talk in a little bit about some creative financing strategies that sometimes business owners want to use to kind of get around that. But yeah, typically 20% down. And then there are some other requirements in terms of your debt to income ratio. You have to have at least 6 months of cash reserves and 6 months of rent, in cash reserves. This is just kind of like a just in case fund. The lender wants to know that if they approve you for this loan and once you actually own the property, that you're going to be able to keep up with it, not only from a maintenance perspective, but also a monthly mortgage perspective. And then again, the credit scores, typically they're lending 640 and higher, minimum credit score 640 and higher. Obviously, the higher your credit score, the more favorable the terms. With some of these changes that have taken place with the rate, I do believe that even some of those people in the 640s are having a hard time qualifying because of the other requirements. And so I know Kristen has some lending partners. I have some lending partners that we're happy to connect you with so you can evaluate all your options. Lenders typically have a variety of loan products, okay? For some of the business owners out there that have high revenue generating and really established businesses, there may be some lending opportunities there for your business to purchase the property. Again, you have to be able to prove a pretty long track record of income. So that would be something that you want to discuss directly with the lender. And then in terms of other creative financing options, I do believe that we will start seeing some more seller financing options and loan assumption options. And what that means are, my theory, I haven't seen it yet, but my theory is a lot of those homeowners that took the forbearance option when COVID first hit, the can has been kicked down the road a lot. And there's only so long that the lender will continue to forbear those payments. Well, even though those payments have been pushed out, interest is still accruing. And in some of those forbearance options that people took, they have a certain deadline to come up with this full cash payment to get caught up. And that is not necessarily something that a lot of these people are able to do. What that means for us investors is there may be opportunities for us to help those homeowners out and say, look, I will assume your loan and you get to assume all of their terms, and basically your down payment basically would get the the mortgage caught up. Okay. Now there's a lot of intricacies with loan assumptions, with seller financing, especially if the seller is doing the financing and they have an existing mortgage. It's called a wraparound mortgage. So there are some things that you would want to consult with me or a lender or whoever to make sure that you are setting yourself up for success if you do one of those creative financing options. Personally, especially when I was self-employed, I purchased quite a few properties owner financing. And the benefit of that was I only had to put a very small amount of money down. I actually got lucky because I owner financed it from a few properties from a client. I got lucky in that he was only charging me like 1% over whatever his interest rate was. But again, as the market shifts from a seller's market to a buyer's market, I think we're going to have an opportunity to really negotiate those terms and really win, and also help the other distressed seller win. So that's what I've got in terms of requirements and overall readiness. I always ask new investors that I'm working with, can you afford to be a real estate investor? Because you don't want to be strapped. You don't want to sink this money into this property if you're actually buying the property and not a REIT, and then just be not have enough cash to do the renovations, to do the marketing, to pay your property manager and all of these things. And so generally you do want to have at least 6 months of potential rents in terms of cash reserves. And then when you're doing your analysis of if a property is right for you, factor in that potential maintenance, factor in that potential vacancy. I estimate anywhere from 5 to 10% maintenance and 5 to 10% for vacancy. Will it significantly alter your numbers and your projected return on investment? Absolutely, it will. But you want to be somewhat conservative, again, so you don't get caught and be one of those people that I've seen has dove in, isn't able to sustain it, and then has to quickly wholesale the property and ends up losing a lot of money. Okay. So just like Kristen put here on the slides is perfect. No high interest debt, fully funded emergency fund. I love that. And then have started to build net worth using DCA in retirement accounts. So yes.
So dollar cost averaging, or just putting money in systematically into your retirement plan.
Yes. Yes.
So it's interesting on residential, I usually tell people they should consider like 1% as their maintenance. 1% of the value of the home annually is their maintenance. So hearing you say 3 to 5% for rental makes sense that it should be higher, but I had never thought about that.
Yeah. And real quick, my perspective really comes from investing in single family homes. I have helped a lot of clients between acquisition and management with apartment complexes and duplexes and some of those smaller multifamily. It still applies, guys. We still want to estimate that I say 5 to 10% for vacancy and maintenance. Okay. It's probably extra conservative, but that's usually how I roll. And then just end up happy on the other side. And then not to mention doing property inspections. Make sure that you're having the property inspected, because when you're under contract, and ideally you negotiate a due diligence period, also known as the option period in some circles, then once you have that inspection report, you could further drill down in your numbers and make sure that you're allocating enough, because you can kind of project future capital improvements.
That's really good to know. I know just the last thing, I have been talking to a couple of clients who've been really interested in commercial lately. For whatever reason, large chunks of money during COVID. I won't get into too many details, but I know that it's the lending is more based on just like the cash flow of the property.
Yes.
Can you talk a little bit about commercial?
Excellent. So yes, there are different types of commercial property, like different classes. Okay. And absolutely, when you're dealing with commercial, it's all about the income generation and overall return on investment of the particular property. Okay. Now, commercial can mean anywhere from like a small strip mall. It could be a large apartment complex. It could be even just a standalone building that's zoned for commercial use. And there the requirements are going to be a little bit more stringent, because in a lot of cases, those properties they cost more, they're selling for more. It's a little bit more risk for the lender here. And if you are considering a commercial property, you want to be very, very diligent in understanding what is happening around the commercial property. If it currently is occupied by businesses, diving deeper into those businesses. Typically, part of the due diligence or feasibility period is what it's called, is requesting estoppel certificates and different certificates to understand the overall health of the businesses that occupy the property. That's going to be really important, especially because businesses took a big hit. Commercial property took a big hit in COVID. Okay. And so now I do project as kind of we come out of this, I do think that there's going to be some really amazing commercial investing opportunities for people. At the same time, we want to just be really, really careful, because if you're buying an asset that really only appeals to a certain type of business, you are significantly limiting yourself. Not to mention, you always want to build in an exit strategy when you're talking real estate investing, right? So if you're like, this is only going to appeal to one type of business, I really think you need to talk to your tax professionals, your brokers, Kristen, to make sure that you have a good comprehensive strategy. And again, lending partners, Kristen and I both have commercial lending partners. The lending partners for commercial properties differ from residential properties. And so we're happy to make those connections with you. And yes, you are going to have to show a little bit more, a lot more income, a lot more cash reserves, depending on the price point of the investment that you're making. And they want to make sure that you're a qualified investor before lending so much.
Yeah. And I'm really excited that we're at a place, I say we, myself and clients are at a place where we're having conversations about commercial real estate. Because I don't think 5-10 years ago, this would have been on our radar. So that's really exciting to me.
Absolutely. That's a fun place to be.
Yes. Let's talk a little bit about tax benefits.
Yeah, so I want to tread lightly here because I'm not a CPA. I'm speaking from personal experience. We know as business owners that just a business is an asset, and there's a lot of tax benefits to being a business owner. And I love that. And I'm thankful for that. On the real estate side of things, there's a lot of benefits in terms of depreciation. That's a huge one. You can depreciate your real estate for over a certain amount of time, deducting all of your mortgage interest, deducting all of your expenses related to the rental property. For example, if we're getting a little bit specific, property management fees, any commissions that you pay, whether it be to acquire a tenant or to acquire a property. Typically, you take your settlement statement, you give it to your CPA, and they basically extract every single possible deduction on the acquisition of the property. And then just general expenses. So if you pay somebody to repaint it or do repairs or whatever, generally your property management company is going to keep really good records for you to take advantage of those things. But I think depreciation, mortgage interest expense, those things are some of the biggest deductions that we see as real estate investors. And benefits, future speaking, is, you do have, you will generally experience appreciation. That's additional benefits. That's not necessarily a tax benefit, but the overall value of the property and your equity is going to grow over time. So that's good.
I love that on the last slide, you mentioned having an exit strategy when you purchase a property, because truthfully, you should always have an exit or an end goal in mind.
Yes.
If you're building any kind of business. And so this, just like anything else, just like my business, is a business that could, in theory, be leveraged, could be sold. And so knowing kind of where it's going, if you're building it so that you can have income in retirement, or if it's just diversifying your portfolio with some other end game in mind, then it's important to know what you're trying to accomplish.
Absolutely. And that is really important when you're trying to figure out what kind of real estate investing you want to do, right? Because if you're investing in a commercial property, the pool of eligible buyers available and ready, willing, and able to buy that property, if you choose to sell in the future, is a lot smaller than a single family home. Okay. Right. The pool of buyers looking at condos, if you invest in a condo like an Airbnb, is also a little bit smaller than the pool of buyers looking for a single family home. So that's something to consider.
That is.
Yeah.
I'm like considering it now. I don't know why. So we've got a couple of people on the call right now, but no questions yet. If there are no questions, we'll wrap up, but I'll give it a second and see if
I have a question for you.
Ooh, what is it?
So, I've talked about where real estate is right now. And do you see an impact of where we're at from a real estate perspective on some of the other types of investments that you help your clients navigate?
That's a really interesting question. I don't know. I think like the biggest impact is what the Fed is doing. So I've explained this a few different ways, and you explained it really well earlier, so I won't totally belabor the point, but we got a lot of stimulus money in the last couple of years. The Fed looked at what was going on in the country. We all stayed home. No one spent any money, and they were like, we need to get these guys to spend money. So they lowered the interest rates to nothing, which made money really cheap and enticed us all to spend a ton of money. And so we've seen, I like to think about like the Target stock and Target recently. We've seen people spend nothing, a ton of incentive to spend, people way overspend and kind of spend into their future need. And then interest rates go up and it gets more expensive to spend. And then people are like, I don't want to spend anymore. And then it's impacting like retail and just really the economy as a whole. And so it's important to remember that one, this was done on purpose. And the Fed's really good at what they do. And so, and also it's been done before. It happened in 2009, I think in 94, in the 80s. It happens over and over again. It is the way that the federal government puppeteers the economy.
I was going to say,
a very normal thing.
All of this is a cycle. Even real estate is a cycle. There's going to be times up. There's going to be times where it's down. And I really think that those people that are not afraid, that do their due diligence, will win in it all. Because I'm a testament of that. In a down market, I won. In an up market, I won. Right. And I think that's the whole key, or one of the reasons behind that is it shows the importance of a team, having the right team, having you, Kristen, to help navigate these waters, having a real estate broker like myself that's an expert in a particular area, really show historically, this is what has been. This is where we see it's going. And here's how we insulate ourselves from some of the possible changes that could come, because we know change is going to happen. And I don't think change is something to fear. I think we position ourselves well when we do our due diligence and work with our team.
Right. And I think that's why it's so important to work with professionals, just because we have a pulse on what's actually going on in the markets and really understand and have not a lot of fear around a market like this. I actually am weirdly excited, and I don't like to admit to everybody about a market like this, just because it's such a great opportunity. This is when people really make money.
Absolutely.
People who are dollar cost averaging, again, just systematically buying when stocks are on sale. When real estate is down, people are like, oh, it's a great opportunity to buy. When the stock market is down, people are like, I think I should pull all my money out. And you're like, you wouldn't do this. If there was a sale at Nordstrom, you would not pull all of your money out. You would take your money out of your wallet and you dump it into things at Nordstrom. At least I would. So it's just, it's this weird thinking about the stock market for some reason. But this is the time when millionaires are made.
Absolutely.
There's great opportunities out there. It's just about kind of vetting, working with a pro to figure out what the right ones are.
Absolutely.
And just being consistent.
Excellent. I love that. Thank you for having me. I appreciate
You're
this.
welcome.
Great
You're
conversation.
Welcome. Okay. So we could both talk about this all day. But if you have any questions and you want to reach out, there's all of the many ways you can get a hold of me. Courtney, I obviously can put them in touch with you, but how should you want to connect with?
Yeah, you guys, when I tell you, since I started at Redfin, I have not really been on my social media game. And so I think the best way to reach me is going to be to email me, courtney.king@redfin.com. Super easy. And the best way also, if you want to get connected with one of my hundreds of agents in Texas, is go to redfin.com. We have the best real estate app to keep your eyes, ears, and everything open, and know exactly what's happening in any given area across the United States and Canada. So that's where you can find me.
In case I decide to run off to Canada, y'all can help me with that?
We sure can.
Awesome. Well, thank you very much, Courtney, for your time. I greatly appreciate it. Congrats again on your promotion.
Thank you.
And we'll see y'all in real estate land.
Awesome. Thanks, Kristen.
Bye.
Bye.